Happy Saturday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Europe, Asia, and North America. My name is Tony. We have a big episode, so let's jump in. And first up, top executives at several of Russia's largest banks are quietly preparing for a potential bailout, as internal assessments suggest a far more precarious financial outlook than official data implies. According to current and former officials and documents reviewed by several outlets, including US-based Bloomberg News and UK-based Reuters, at least three systemically important lenders have privately discussed the possibility of requesting state recapitalization if bad loans continue to surge over the next 12 months. Although the Bank of Russia has projected confidence, stating that the banking sector remains, quote, well capitalized, end quote, with 8 trillion rubles, $102 billion in capital reserves, internal conversations suggest otherwise. Executives say the true quality of their loan books is deteriorating faster than acknowledged publicly, driven by rising defaults among both corporate and retail borrowers facing record high interest rates and growing economic pressure. The official non-performing loan NPL figures remain comparatively modest, 4% for corporate borrowers and 10.5% for unsecured consumer debt as of the 1st of April of this year, but these numbers may understate the severity of the situation. Many borrowers are restructuring loans or deferring payments, which temporarily masks the depth of the problem. VTB, Russia's second largest lender, saw its share of non-performing retail loans climb to 5% in May, up 1.2 percentage points since the start of the year, and expects that figure could reach as high as 6 to 7% by 2026. Despite reassurances from the governor of the Bank of Russia, who dismissed fears of a systemic crisis during a financial forum in July, internal assessments by some of the country's largest financial institutions suggest that the sector may soon need support. Executives have discussed with increasing urgency how to approach the central bank should recapitalization become unavoidable. The possibility of a banking crisis comes as broader economic pressures mount. The Russian economy, which expanded 4.5% in 2024, has slowed sharply to 1.4% growth in Q1 of this year. Inflation peaked above 10% in the overheating war economy, prompting the central bank to raise its key interest rate to 21% in October. A modest rate cut to 20% this month offered limited relief. Tensions between top Russian economic officials surfaced publicly at the St. Petersburg International Economic Forum. Economy Minister Reshetnikov warned that Russia was, quote, on the verge of slipping into a recession, end quote, a statement disputed by central bank and finance ministry leaders. President Vladimir Putin later acknowledged concerns about stagnation, but insisted such a downturn, quote, must not be allowed under any circumstances, end quote. In the background, banks are growing more cautious. The corporate loan portfolio shrank by 1.5 trillion rubles, $19 billion in the first 2 months of 2025 before stabilizing. Analysts point to early signs of a credit crunch, with banks tightening lending amid fears of rising defaults. The sector is also contending with the consequences of wartime lending. Many banks extended favorable loans to companies supporting the Kremlin's war effort, loans that now threaten to turn sour. A central bank report in May identified vulnerabilities, including credit and concentration risks in corporate lending, with 13 of the country's 78 largest firms unable to service their debts, twice the number from a year earlier. Then on Friday, yesterday, the Kremlin got more bad news. The European Union approved a sweeping new round of sanctions against Russia, tightening pressure on the Kremlin's war economy, with measures targeting its energy exports, banking sector, and trade partners. The package, its 18th since Russia's full-scale invasion of Ukraine, introduces a revised oil price cap, expands financial restrictions, and blacklists more vessels and companies facilitating sanctions evasion. Key among the new measures is the overhaul of the Russian oil price cap, previously fixed at $60 per barrel. The cap will now be set dynamically at 15% below global market prices, starting between $45 and $50, with regular biannual reviews. The EU also imposed curbs on fuels such as diesel that are refined from Russian crude in third countries like India, a significant step given Europe's reliance on Indian diesel. Further sanctions will cut about 20 more Russian banks off the SWIFT and impose a full transaction exportation ban. After weeks of delay, the package was finally approved yesterday morning following Slovakia's agreement, secured after EU assurances on fossil fuel transition plans. For Putin, managing the health of the banking sector is critical not just economically but politically. A financial crisis would undermine efforts to sustain the war in Ukraine and could become a critical pressure point as Western allies debate additional moves against Russia's financial institutions. Next up, Apple Inc. has struck a landmark $500 million deal with MP Materials Corp, marking a major step in the United States' push to secure a domestic supply chain for rare earth minerals. Under the agreement, Apple and MP Minerals will jointly build a rare earth magnet manufacturing facility in Fort Worth, Texas, specifically tailored for Apple products. Shipments are expected to begin in 2027. The deal comes just days after the Pentagon announced a $400 million equity investment in MP Materials, cementing its position as the company's largest shareholder. The Department of Defense will also purchase magnet materials at a guaranteed floor price, a move aimed at stabilizing the industry and ensuring supply for military and strategic technologies. Backed by $1 billion in financing from JP Morgan Chase and Goldman Sachs, the funds will support the development of a second magnet facility dubbed the 10X facility at a still undisclosed location. Apple said the investment aligns with its commitment to inject over $500 billion into the US economy over the next 4 years. Quote, "Rare earth materials are essential for making advanced technology," end quote, said Apple CEO Tim Cook, adding, quote, "This partnership will help strengthen the supply of these vital materials here in the United States." End quote. MP Materials operates the only rare earth mine in the United States, located at Mountain Pass, California. As part of the broader initiative, Apple and MP will also establish a rare earth recycling line and collaborate on next-generation magnet materials. Shares of MP Materials surged as much as 60% following the announcements, while Apple rose modestly. The developments come amid escalating concerns over China's dominance in the rare earth market, which accounts for 90% of global magnet production. Beijing's recent export restrictions imposed in response to US tariffs disrupted global supply chains and forced companies like Ford in the US and Suzuki in Japan to cut production. We followed all of these developments, of course, on both Market Update and my other channel, China Update. Analysts see these moves as a turning point. Quote, "The scale of the US commitment underscores the strategic importance of rare earth magnets and directly counters China's rare earth dominance," end quote, Jefferies Group wrote in a note on Friday. The Pentagon's involvement, Apple's long-term demand, and rising geopolitical tensions are driving a new industrial policy baseline, one that could reshape the economics of critical minerals across the West. It has been for this reason that this channel in China Update has worked primarily with North American-based commodities mining and refining companies as sponsors of the channel over the last year or so. Now, if you want to be on top of the most up-to-date analysis on the biggest moves in the most important markets around the world through grounded and sober analysis, consider subscribing to Market Update, hit the bell notification icon, and you will be. And if you're getting some value from today's episode, don't forget to hit the like button. And finally for today, we move to Asia. Thailand is taking major steps on multiple economic fronts, working to avoid steep US tariffs, reviving its struggling tourism sector, and managing domestic economic pressures as the country seeks to stabilize growth and attract investment. Following weeks of negotiations, Thai Finance Minister Pachai said Friday that the country expects the United States to reduce its proposed 36% tariff on Thai exports to a level more in line with regional peers. This comes after Thailand submitted a, quote, "very substantial improvement," end quote, in its trade offer to Washington, meeting all US demands, including expanded market access for American goods and a broad reduction in Thai trade barriers. Thailand's latest proposal raises the share of US products receiving zero tariffs from 60% to 90%, and includes increased purchases of US agricultural goods, liquefied natural gas, and Boeing aircraft. The country also pledged to ramp up investments in the United States, including in Trump-endorsed energy projects like Alaska's gas initiative. Quote, "We hit the target in the best way we could," end quote, said Pachai, who leads Thailand's negotiation team, adding, quote, "We predict we'll be getting similar rates as Vietnam and Indonesia, not more than 20%. end quote. US President Trump, who announced last week that tariffs on Thai goods would begin at 36% on the 1st of August, has imposed 20% duties on Vietnamese goods and 19% on Indonesian exports. A favorable resolution for Thailand is urgent. The US is the largest buyer of Thai exports, accounting for 18% of total shipments in 2024. A 36% tariff could cut Thailand's projected GDP growth by up to 1 percentage point. Pichai emphasized that Thailand's economy must adapt to new realities, not merely by importing more US goods, but by growing its export base and investing in competitiveness. The government will monitor potential fallout on domestic industries and small businesses, offering support where needed. Meanwhile, bond markets are signaling concern. Yields on Thailand's 30-year sovereign bonds have dropped to the lowest level since 2021 as investors seek safe assets amid trade uncertainty and domestic political strife. A recent auction of these long-dated bonds saw the strongest demand in 2 years. In contrast, 10-year bonds failed to meet their target, a sign that investors are worried about short to medium-term fiscal planning. With the Prime Minister suspended over alleged misconduct, investors are also watching to see whether the weakened coalition can pass the $115 billion budget bill by the end of August. If tariffs remain high and political gridlock deepens, economists expect the Bank of Thailand to cut interest rates from 1.75% to as low as 1%. As Thailand works to shield its economy from external shocks, it is also urgently trying to revive its once booming tourism sector, particularly by luring back Chinese visitors, whose numbers have fallen over 40% in recent months. In 2019, pre-pandemic, Thailand welcomed almost 40 million tourists, with over $17 billion worth of revenue coming from Chinese visitors alone. However, a series of safety concerns, including the high-profile kidnapping of a Chinese actor by an online scam group earlier this year, has undermined Chinese confidence in visiting Thailand. The Tourism Authority of Thailand has reduced its 2025 target for foreign arrivals from 39 million to 35 million, with expected revenues of $54.5 billion, far below pre-pandemic levels. As Thailand navigates volatile trade relations, weak consumer spending, and regional competition for tourism dollars, the country's ability to strike deals, adapt policy, and manage perception may prove crucial to stabilizing its fragile recovery. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Saturday. Have a restful weekend, and I will see you for a new week of updates on Monday.